Hello and welcome to the Confidently Retired YouTube channel. My name is Jeremy Hernandez and I'm here with the man, the myth, the legend, Confidently Retired owner and your financial advisor, Jared Knoll.
How's it going?
So Jared, we're doing this first time ever financial advisory YouTube platform for people like you to ask questions. So I have several lists of questions that we're going to be going over taxes today. This is what we're going to go. Retirement tax bombshells. Avoid these costly mistakes.
Sure.
What are some bombshells that people might be dealing with at this moment, and how could we give them some advice to avoid those costly mistakes?
Sure. Well, there's a handful of tax bombshells that people run into in retirement. Number one would be taxes on their Social Security. That's going to be a big problem. Taxes on Medicare. Well, it's not necessarily taxes on Medicare, but it's additional Medicare premiums that people have to pay because of their income. It's called an IRMAA cliff. And then there are other taxes that people have to pay in retirement. You know, there's the capital gains taxes that people pay. Typically, that's looked at as a good thing because those taxes can be lower than traditional income taxes, but not always. Then there are just other taxes that people pay in retirement, of course, but we want to make sure that people get their taxes as low as possible. Taxes that are left to your heirs to pay if you don't pay them during your lifetime can be a problem as well. And so we look at taxes on estate planning as well. There are tons of taxes that are going to be paid typically on money that taxes have been deferred on. The retirement accounts you have put off paying taxes on. So we want to look at some of that today.
Gotcha. So majority of the people who are tuning in, you guys are worried. You're basically worried about if taxes will be eating into your retirement savings. So
Absolutely.
If you have questions, make sure to comment them down in the comment section so we can address them on a later episode. We can do a follow-up to this. As far as someone who's worried about that savings, where's step one of where they should start?
Step one is to, reach out to us and ask for an income tax analysis. That's something that we provide. I can do that as a complimentary service for, the folks that reach out to us. It's one of the things that we do to try to help get people off on a good start for their taxes and retirement guide. It's not something that we do free for everyone, but we will do it for a few people that reach out to us today. So if you want to DM us and reach out in the comments below, we'll tell you how to get in touch with us in the comments below. So be sure to do that. We will provide that. It's a service that we do. And so that's step one. Ask for an income tax analysis report.
Gotcha. Now, some mistakes that people make when going into their taxes. They bring you a receipt box, basically, or some people just bring you all their tax returns.
Sure.
Step two is like when they're coming in for their analysis, what should be the advice you'd give someone when they're coming in?
Number one, I'm not a CPA. I am a CFP. Acronyms kind of run together and they look the same. A certified financial planner and a certified public accountant are not the same thing. I can help give tax advice as a CFP, but I don't do tax returns. We look for mistakes that people make whenever they are filing their taxes and ways to reduce their tax bill, but we don't file tax returns.
Gotcha.
So that's number one.
So definitely don't bring your taxes, get your taxes done by him. But you said looking for mistakes.
Yes.
Explain that, because what can be mistake wise as far as like if you're going for retirement, your savings?
So not taking advantage of some of the deductions and things that are out there that you can take advantage of is definitely a mistake. Taking too much money out, not taking it out of the right accounts, not planning to make contributions, making Roth contributions in the latter years of retirement when you should be making contributions to a traditional retirement account. If you're latter in your working years and you're a higher income earner, there are years that you can take advantage of making traditional retirement account contributions, and it'll bring your income down in those latter years when maybe you're a higher earner. And you think, well, I want to make a Roth contribution. That is definitely a mistake. You want to take advantage of the traditional retirement account contributions to where you can bring your earnings down and then maybe do a Roth contribution or Roth conversion after you've retired, and then pay a lower tax rate on that conversion instead of paying a higher tax rate on the contribution itself.
Gotcha. So the contribution. I have a question.
Okay.
Does tax rates, do they fluctuate?
Tax rates do fluctuate based on your income for the year. So tax rates aren't set. They do fluctuate based on your income from year to year. If your income fluctuates from year to year, say you are in sales or you get big bonuses from one year to the next and your bonuses fluctuate, then your income will fluctuate from year to year. If you are on salary and your salary is going to stay the same from one year to the next, then you're pretty much in a set tax rate. But you're otherwise, if you're in sales or you get big bonuses and things like that based on production, then your income will fluctuate and your tax rates will fluctuate. So you can look at, if you have a volatile income, you'll have a volatile tax rate.
Wow. Hopefully you are getting a lot of out of this, because I didn't know that you said if you had a set salary that your tax rate would be set. I didn't know until today's episode that taxes could move like that. Yeah. Step 3, because we got step 1 and step 2 out of the way. What would step 3 be before we come in, when someone is coming in to meet with you, that they should have ready?
One of the step 3 that they should have ready would be having their retirement account statements organized and ready. It's always going to be a big thing, because we want to look at not only how to save for retirement, but to plan the distribution phase as well once you get into retirement. Because one of the big steps is not only accumulating money for retirement, but then to plan how to take that money out in retirement. That is huge. It's just as important, if not more important, than getting the money for retirement, because you want to make sure that money lasts the rest of their lifetime, and then making sure that that money comes out in the most efficient manner as possible. And so having the accounts organized and having statements ready for us to review is huge. And we look at those statements and then look at how to rearrange those and distribute the money so that it comes out in the most tax efficient way.
Gotcha. You said something there. Is there any tax traps that people can avoid?
Oh, most certainly.
There's tax traps in the tax code that... Okay. Guys, so what I just understand is there's tax traps that you could be falling to right now just because this is not something that we're educated. You're here and you have your job, you go to your work, and you have these responsibilities to your family. You go home and live your day-to-day life. I don't study taxes for a living.
I do.
But you do. So what are some tax traps? You might want to be curious about this, but what are some tax traps that we should be avoiding?
So one of the things that people talk about wanting to do is Roth conversions. And those are great things to do, but how much you do a Roth conversion for as you near retirement and things like that. Say somebody's on the verge of retirement and they're already filing for Medicare and they're receiving Medicare in retirement, but they decide to do a large Roth conversion. They've got several $100,000 in their retirement accounts and they're on Medicare, but then they do a Roth conversion for $200,000. That's going to push them up into a higher Medicare premium base. So they're going to have to pay another several $100s a month for Medicare premiums that they wouldn't otherwise have to pay.
That's what I had written down here, Medicare premium surprises. And because someone falls into a tax trap, they can be basically screwing themselves because of the Medicare premium surprises. They're getting now.
It's called the IRMAA cliff. Yeah, the income-related Medicare adjustment. Yeah.
Okay. We're going to put that down at the bottom. It's called the IRMAA cliff, and it's, what is it again?
The income-related Medicare adjustment.
Okay. And to everyone who's watching, what would that mean in the layman's terms?
It means that they have to pay more for their Medicare premiums because they brought in more income. And even if you do a Roth conversion, that's considered taxable income for Medicare premiums. And it'll also cause their Social Security to be taxed at a higher base as well. So your Social Security is taxable either at 0%, 50%, or 85%, depending on the amount of income that you bring in retirement. And your Medicare is taxed at various tiers as well. I think there's 5 different tiers that your Medicare is got additional premiums that you pay based on the amount of income that you bring in. And we've got different tables and charts that show that for you. We can provide that if somebody wants that. In fact, we can probably just put a link down in there that they can download that information for free.
Yeah, we'll put a link down in the YouTube description or the Facebook description. Or
better yet, we can put a link to our Savvy Retirement Club that has all of those charts and information in there.
Yeah.
So that they can just access our Savvy Medicare planning program.
Yeah. So some of y'all don't know me, and basically why I'm here is because my in-laws are retirement age, my parents are retirement age, and I'm at this point of a lot of my family are getting ready for retirement and they have a lot of questions. And so I found myself in the position of I office next door, and I was like, man, this guy seems to know a lot. And I was like, do you not have a YouTube channel? He's like, no, we need to start one. And so we're starting it, and we have the questions that you're providing and some that we pulled that are people are falling traps to, like the tax trap, Medicare premium surprises. These are questions that I looked up online and that I didn't know. And I'm still getting educated. And thank you, Jared, so much for everything that you've done just for this episode. If you have any questions about further episodes of what we should talk about, I do have one more thing before we go.
You bet.
Okay, right here, managing taxes before retirement.
Sure.
Is there any stages? Because it says there's 4 stages: reinforce, introduce, the late retirement fee, briefly outline key. These are just some that are like RMDs, Roth conversions, IRA challenges. Any of this kind of make sense? What would we like?
Sure. So before retirement, they reinforce the need for pre-retirement tax management. That is going to be making sure that you can do Roth conversions prior to collecting Social Security, and you can defer your Social Security up to age 70. If you retire prior to collecting Social Security, you can take out some of your retirement account. You can take distributions from your retirement accounts to supplement your income. Maybe if you have a pension, you can withdraw from your retirement accounts to delay your Social Security. That's one of the things that we'll probably get into in another episode, is strategies in order to delay your Social Security. There are many, many reasons to do that. Probably don't have time to get all into this episode. But that will also help bring down your required minimum distributions for later. It'll give you chances for bringing down the levels of your required minimum distributions. That's when the IRS forces you to take money out of your retirement accounts. There's many, many benefits for controlling those required minimum distributions. It'll help reduce the taxes on your Social Security and your required minimum distributions later on. There was another question that you asked. What was that one, Jeremy?
The IRA challenges, Roth conversions, RMDs.
And in certain situations, it makes sense. We talked about whether or not to contribute to a Roth IRA or a traditional IRA, a Roth 401k or a traditional 401k. It's going to depend on your situation. They've recently changed the laws. If you're making catch-up contributions, some of you will be forced to make catch-up contributions to a Roth 401k instead of a traditional 401k. It depends on whether or not you're considered a high earner or not. So those are just things that you're going to have to evaluate on an individual circumstance. You won't all have the option of making catch-up contributions to a traditional 401k if you're considered a high earner. So all of that, you'll have to make on an individual situation to determine which one's going to be the alternate or best route for you. But we're happy to help provide guidance in any situation that we can help with, and reach out with your questions. Ask any question you want, and we'll do our best to answer them here on the channel.
Yes. So thank you so much for stopping by. Thank you for the Confident Retired YouTube channel. This is episode 1, and I am very appreciative of your time. And if you have questions, like I said, leave them down in the comments below. Click the link down below if you would like any of the information that we talked about in this episode. It's going to be at the confidently retired.com website.
And one last thing, another plug for our Savvy Retirement Club. It is a free program that we put out there that has tons, absolutely tons of information. You can join that for free. Look in the link below, and we've got information on Medicare, long-term care, IRA planning, savvy cybersecurity to help prevent yourself from getting hacked online and protect yourself there. Medicare information. There is absolutely tons of information, checklist, white papers, and tons of information that you can get besides just watching this channel.
Wow. You came to the right place. We'll see you later. Stay confident and get ready for retirement like you've never had before.
Take care.